Hello everyone, my name is Adam and welcome to our SBR session CBE exam approach and question practice. In this video, I'm going to show you how to structure or plan your answer for a typical question 2, which is a mix of an accounting issue and ethical considerations. So still on the September 2018 paper. So let's start with the requirement. So we'll open up the requirement. Let's see what is here. Total marks, look at it. We have 11 for requirement A, B 7, and always remember for question 2, you have your professional marks of 2, which is given for your ability to demonstrate your ethical awareness. So in all of this you have 20 marks. So let's quickly copy like we have always done. Let's copy the requirement, Control C. Let's open up the word processor and paste in it. So let's do that. So I've pasted it in the word processor. So I have B to be separated from the A, and then let's say put down the professional marks as well. Now if you look at it carefully, I can close the requirement now so I can have a good view of the word processor. The requirement A says that discuss the accounting treatment which Fahamco should adopt to address each of the accounting issues above for the consolidated financial statement, and then B, discuss the ethical issues arising from the scenario. So now what we will do is that we will have to structure our answer by reading the exhibit. But before we read the exhibit, let's read so I can close this quickly or try to resize it. So I can read it's better to close it. Let me read the introduction to the question. Now it says that Fahamco is a manufacturer of domestic goods. So that's their business. Fahamco operates a profit-related bonus scheme for its managers based upon the consolidated financial statement. But recent results have been poor and bonus targets have been really have rarely been achieved. As a consequence, the company is looking to restructure and sell its 80% owned subsidiary Newell Co., which has been making substantial losses. The current year end is 30th June. So let's take note of that year end, 30th June. So I can highlight that. Yes, just to highlight it, 30th June. So I would have to take note of that. Now, the following exhibits, so we have 1, factory subsidence, and then the sale of Newell. So on the left, you see that the exhibits are here, 1 and 2. Now, in terms of the ethics, once I see this, it says that Fahamco operates a profit-related bonus. So I can copy that and try and put it in my, so I'm copying, I'll put it in my processor and tag it as an ethical issue. So if I come here, I can just paste it here. I'll work on it later as an ethical issue. So because that's an incentive for possible manipulation or non-compliance with standards. So now I have read the introduction. My next plan is to open up the exhibit one after the other. So I want to deal with the factory subsidies. So I'll open this up, resize it like I've done in the previous video. So I want to resize it such that I can at the same time move within the word processor and the exhibit. So I have it this way, so I can move within it, I can move out and in, out, in. Good. So now let me come back to the exhibit to read. Now the first is the factory subsidies. So what I will do is to type the first issue, the accounting issue. So factory subsidies. I would just want to bold it and then begin to look at what I would put in there, because these are accounting issues. So you first have to have the structure. What is the issue? Understanding of the issue is critical for the exam, and then also you talk about the accounting treatment. So I can just have that simple heading. So I'll say issue, accounting treatment as these headings. So here I can bold these ones as well. I'm developing a good structure for or answer plan, so I can have this separated, also this separated. Great. Now I want to go back and read the exhibit. So it says that Farmco has a production facility which started to show signs of subsidence. Signs of subsidence means that there is a damage since January X8. And again, you look at the year end. The year end is 30th June X8. So it is within the year. Now, it is probable that Farmco will have to undertake a major repair sometime during 20X9 to correct this problem, or to correct the problem. So what I want to copy here without highlighting, I would say that let me copy all of this, Control C, come to the issue here and paste it. So I'll just unbold that quickly. Now the reason I've copied that is that there is a subsidence to a factory. It's part of the issues. So let's proceed. Now, Farmco will have to undertake a major repair sometime during X9 to correct the problem. Farmco does not have an insurance, Farmco does have an insurance policy, but it is unlikely to cover subsidies. The Chief Operating Officer refuses to disclose the issue at 30th June X8 since no repair costs have yet been undertaken. So this is the finalization of the issue. I'll copy that as well. Come here and then say V. And these are the major issues I have been able to take from the exhibit. So Farmco facility has experienced subsidies. Now the Chief Operating Officer has refused to disclose this in the financial statement. I've been able to summarize this. Let's move on. Now, even though she's aware that this is contrary to international standards, so you're looking at the ethical concerns there, ethical considerations. Now, the CEO does not think that the subsidence is an indicator of impairment. So I have information here for accounting issue. So I'll put it here. So just to unbold it. So that when I come back to develop the accounting treatment, I can talk about it. I'm using the content of the case. So let's move on. She argues that no provision for the repair to the factory should be made because there is no legal or constructive obligation to repair. So I need that information as well. So let me just paste it there. I'll come back to deal with it. Now, Farmco has a revaluation policy for property, plant and equipment. and there is no balance, and there is a balance on the revaluation surplus of 10 million in the financial statement for the year ended 30th June. None of these balance relates to the production facility, but the CEO is of the opinion that this surplus can be used. So I need some information here so I can work on as I develop my accounting treatment. So what I have here is to put it here, paste it here. So I'll talk about it. Now what we have done is that we have engaged the financial reporting areas, and I want to build a bit on the, so I've closed it. I want to build a bit on the ethical issues. Now the framework for the ethical issues is to first start with, so I can have a major heading and say is here, it says that the ethical issues. So I'll copy that, paste it here, and then also any actions. So any actions, so I'll copy that as well. So bring it down, paste it, and then just edit this a bit, and then also have this, the ethical issues. So I'll bold this one, I'll bold this one as well. Now under the ethical issues, as we have learned throughout our sessions, our revision sessions, we learned that your ethical discussions should start with ethical responsibility. So I'll have a quick structure, a plan, so that as I come back, I'll begin to develop them. So I'll have ethical responsibility or ethical duty. The next thing to look at is what are the ethical issues, the issues, or I'll say, instead of the ethical issues, not to confuse you, I'll say the ethical principles. So as I've talked about the ethical principles, then finally the major issue would be to look at what the actions to be taken. So I'll copy this one here. So I'll cut it actually, Control X, or I'll just use the right click, cut it, and come and paste it under the ethical principles. Now what I want to do now is that I want to copy portions of the issue I have summarized. So I'll copy this again and come and put it as part of the ethical issues or the ethical principles as I begin to develop it, because the refusal to disclose that, as you are aware, that will be a professional competence issue, and also would have to ask questions about the integrity and also professional behavior. So as you begin to do this, you are developing a very good answer structure, which you're going to be using when you come back to flesh it up, and you would be on your way to securing a lot of high marks. All right. So the other issue would be to look at the fact that the possible reversal of a potential loss, which will be used to offset a different asset balance. So which is the last point here. But again, this is a good structure to look at from the first exhibit. So what I'll do next is to look at the next exhibit. So I'll look at the next exhibit. So I'll open it up, which is the sale of the new wall, resize it so I can read at the same time. I can move in between. So let me go up and start reading it. But before then, I want to type this. So let me go in here go to the accounting issue, come here and say sale of New World Co. I'll bold it. Again, just as I have done for the factory subsidies, I want to look at the issue, so I'll just copy, paste it here, and also I want to look at the accounting treatment, copy, paste it. Yes. Now I can go back to the exhibit, so let me click on it. Okay, good. Now it says that at 30th June X8, Farm Co had a plan to sell its 80% subsidiary New World Co. This plan has been approved by the board and reported in the media. So that's the issue. So let me just look at it. Just try to copy it, come here, and try to develop the issue. And I'll just want to unbold it. Unbold it. Sorry, so let me undo this. Let me undo this. I need to send it to the sale of the, so let me put it here. And you see, this is the beauty of the CBE platform. Even though I've sent it to a wrong accounting session, I've been able to quickly take it from there so that I can push this back. That's the beauty of it, the flexibility that it brings to you as you work through the exam. Now I would want to continue to deal with the exhibit. It is expected that Old Castle Co., an entity which currently owns the other 20% of New World, will acquire the 80% equity interest. The sale is expected to be completed by December S18. Now, what is all of this telling me? This is telling me about IFRS 5, non-current asset held for sale and discontinued operation. And in fact, it is giving me recognition criteria. So what I can do here is in fact look at this and copy up to this. The sale is expected to this, so I can just use that, come back to the exhibit, paste it here, ensure that. So what I'll be doing again under the accounting treatment, I'll look at a heading called recognition, and then after that I'll look at measurement. Those are the accounting issues. And then maybe possibly I can even look at disclosure. So you break it down this way. So you have recognition, measurement, disclosure as the accounting treatment. And all of this information I've copied here, I'll break it down to suit what the IFRS 5 recognition criteria says. That the plan have to be approved, which shows a commitment. So as I come back, I'll begin to put that in the context of the information under the recognition. Then I'll go to the measurement. So let's build on. So the sale is expected to be completed by December. So you know about the 12-month recognition criteria, which says that from the date that the entity has been held for sale, the sale should happen in 12 months. Now, New World Co. is expected to have substantial trading losses in the period up to the sale. So now the accountant of Farm Co. wishes to show New World as a held for sale in the consolidated. So I would want to see whether this is a good treatment, whether it has met the criteria. So I would end here, copy it here, and come back to this and put it here, whether the accountant view met the recognition criteria after I have developed it. So I'll go back, continue, and to create a restructuring provision to include the expected costs of disposal and future. So I'll just want to look at this again to copy. I might put it under measurement. Now the CEO does not wish Newell to disclose, so look at it as another major issue. And it says that the CEO is concerned as to how this may affect the sale price and would almost certainly mean. So I'm going to copy this and watch what I'm going to do. I'm copying it. I'll take it to the ethical issues. So as I come down here, I'm going to build this one here and put it here. I come back, I'm fleshing it up to suit what the contents of the ethical principles which have been breached. And that's how you do it. So I'll go back, look at it. And even to look at this, I can copy just a portion of this one, say that it is part of the accounting issue. So I'll go up here, and put it here to fleshing up the issue, because it's a disclosure issue and a measurement problem. Come back to it and continue reading. Now, the CEO has argued that they have a duty to secure a high sales price to maximize the return for shareholders of Farmco. She has also implied that the accountant may lose his job if he were to put such a provision in the financial statement. So I'll copy this one. It's an ethical principle issue. So I'll come back here and put it under the ethical principles. And that's an intimidation. And any act of intimidation is a professional behavior issue. It's an ethical behavior where the accountant's job will be threatened because of the fact that there should be a provision that have to be recognized, and the CEO is not intending that the accountant recognize that provision. It's an ethical issue. I go back. Now it says that the expected costs from the sale are as follows. So these are the expected costs which would have to be needed for the provision. So future trading losses, I'm thinking which standard? IAS 37. IAS 37 provisions, contingent liabilities, contingent assets. Then various legal costs, redundancy costs, impairment losses, and it says that included within the future trading losses is an early payment penalty of 6 million for a lease asset which is deemed surplus to requirement. So what it means here is that I want to look at the measurement. So look at it. I want to have a view of it and come here under the measurement and to begin to type. So I would want to view it. So I'll say no provision for future, and watch it carefully, future trading losses, except for the early payment penalty. So I'm having a view of it whilst I type, of 6 million. Then I'll say legal costs of, so I'll bring the values is legal cost of 2 million, and then the redundancy, so I'll just put it end, just to ensure, end redundancy cost of, that is 5 million. So the legal cost of 2 million and the cost of 5 million should be part of the total provision. Then no provision should be made for the impairment losses of 8 million. So now it means that this gives a total expected cost of, so what I'll do is just put it together. I have 6 million, so this I do not need the spreadsheet. 6 plus 2 plus 5, so that gives me 13. So I'll put it in front of it in dollar million. So it means that this gives a total expected cost of what? 30 million as a provision in the year end. So I'll just look at in the year ended 30th June 20x8. So when I come back after I have closed the details of the exhibit, I'm now coming to look at the details of the structure I have here and look at it carefully. Look at the work we have done. Just planning your answer, and I would entreat you to continue to practice with several questions and develop these skill of planning and using the content of the case in your answer plan. So what I will do is to start one after the other and look at the accounting treatment. Here it says that the CEO does not think that the subsidy is an indicator of impairment. Now I'll start by saying that as per IAS 36, which is the impairment, IAS 36, impairment of assets. Now this is what you need to know. You need to apply directly to the case. So you are not to list all the possible causes of impairment. So what I will be doing is that as per IAS 36 impairment of assets, the subsidence, so I'll say the subsidence or the damage is an indicator of impairment. It's an indicator of impairment. Then I'll make the next point. An impairment test is required. Just keep it simple. An impairment test is required. Now, the CEO does not think that a subsidy is an impairment indicator. It's not, so I'm going to flex it that it's not consistent with the IAS 38 position. So look at what I have done. Because I have already copied the content, I'm now blending it to my answer. And You see, when you have only copied the content without blending it or without rewriting it to suit your answer, you're not going to earn marks, because it's the exam. Believe me, it's not copy and paste, but you are using the content of the case in developing your answer. And look at how I've done it. Now, I'm going to look at the next point. Now, she argues that no provision for the repair for the factory should be made because there is no legal or constructive provision. So what I will put here is that I can leave this and move on and say that the CEO is correct in these assessments. Since the IAS 37 provisions, so I'll just look at the provisions, contingent, liabilities. Let me just show it. Liabilities and assets prohibits the recognition of future repair costs, and that there is no legal or constructive obligation for Farham. So I want to use a name for Farham Co. to incur such costs. And look at the content of what I have done. It comes with practice. It comes with a lot of practice. So you look at it. Now the next issue to develop here is that the fact that there has been no impairment, the assets, the fact that there have been no impairment test, the factory is currently, so I can just I can leave it at that without editing it. It's not a problem. It's currently overstated, and that the profit for the year is also overstated. You see, as you begin to do all of this, remember the impact of this on the financial statement, and don't forget the incentive. Here is it that they had a difficulty meeting their targets. They have a bonus to achieve. All of these are pushing the CEO, the COO to sort of do some creative accounting so that the profit doesn't reduce, so that provision is not recognized, and so on. And almost all of these would have to come into your development of the ethical issues. Now, let me just talk about this last one. The fact that where there is a revaluation surplus on another asset cannot be used to offset a different asset. That is not consistent with the IAS 16 PPE. So you chip in that as well. Just a one-liner statement or point, and you leave it. Now, when you come here to the sale of the new Allco, the issue we have dealt with it, the accounting treatment, the recognition. So we say that as per the IFRS 5, we can leave it at that. the recognition of assets. Okay, let me look at it. The recognition of a discontinued. It should be a discontinued. So a discontinued operation should meet the criteria for recognition. Now watch this. This plan has been approved by the board and reported in the media. So I want to just highlight this. The approval and the communication of the sale indicate management commitment to carrying out the sale. So here I have used the content of the case. At the same time, I have talked about the explicit recognition criteria in IFRS 5. That there should be a detailed plan in place, and that plan have to what? Show management commitment. The next one is that it is expected that Oldcastle, an entity which currently owns this, would what? Acquire the 80%, and that. So look at it. We can say that a buyer has been identified. A buyer has been identified, and the sale is expected to occur in the next. So you look at it up to December, that will be in the next 6 months. So in the next 6 months, what does it indicate to you? It is meeting the criteria. Now, what I will type to add to it, this suggests that the IFRS 5 recognition criteria has been met. And look at it, the accountant of Farham wishes to show Noah as held for sale in the consolidated financial statement. So what I would say is that the accountant is correct to treat Newell as a held for sale. I'm still using the content of the case, but I have laid enough emphasis and principle. Now, when you come to the measurement, create a provision to include expected. So what we know is that the assets under a held for sale plan should be valued at the lower of carrying amount and their net realizable values, which is the NRV. any impairment losses should be charged to profit or loss. Now, as per IAS 37, a provision should be made for all directly attributable costs associated with any restructuring. Now, I want to see how I can blend this to the content I've copied. Now, it says that the CEO accountant create a restructuring provision to include expected cost of disposal and future trading losses. Now, what we have said is that a provision cannot be created, so I just want to flex, it cannot be created for all the expected cost of disposal and future trading losses. So I have to make that point. So I've been able to reword the content I have copied. So you realize that from the start, I've already talked about indirectly how the provision should be accounted for. So it has merged with my answer. And then you talk about the fact that it needs to be disclosed and so on. So what I'm showing you now, which I will allow you to develop later, is to have a plan and how you can begin to develop it as you answer it. And then when you go to the ethical issue, we talk about the fact that accountants will have an ethical responsibility to provide financial information which is useful to users. And when it is useful, it means that it is relevant and it is faithfully represented. And for directors, they have an ethical responsibility to prepare financial statement which will provide useful information to the users. Any attempt to misrepresent would mean that they have not provided useful information. So you make that point here under the ethical responsibility, or you can just chip in the objective for preparing financial statement. And as you begin to highlight the ethical principles, ensure you bring in which of the ethical principles which have been breached. Is it about behavior? Is it about competence? Is it integrity? And so on. And then you look at the actions to be taken. Already it's a heading you have developed. And you know the actions to be taken. The accountant who is intimidated would have to first discuss the issue with the director, which is the chief executive officer. If the chief executive officer is not able to understand the realities of the impact, you have to consider other directors, particularly the audit committee members. And where these issues remain unresolved, the accountant will need to take further steps by consulting and seeking advice from external parties like the ACCA. And at worst, should consider possible resignation. So we already know all of this, but in the context of the CBE environment, this is how you structure your answer. And I want to believe that we are going to take this as a start and solve or practice with several other questions. So thank you very much for watching, and see you again. Bye bye.